It's the fourth Saturday of the month, which means it's time for Finomoney, the FinTech show. Hello and welcome, I'm Ajay and let's find out what's in store today on the show. First, our first segment, the special package on data theft allegations by the government on RealMe smartphones and also the consequences of geotagging. Then in the next segment, we are going to throw some light on investing in mutual funds through fintechs and the impact of the new regulations in the EOP platform on the industry. Speaking on this would be Mr. Harsh Gehlot, CEO and founder FinEdge. And lastly, our trivia segment Finogyan will focus on the FLDG lending model and why fintechs want them back. We will first look at the headlines, the big five, the movers and shakers that left an impact in the world of fintech. First, Navdan raises $1.5 million in a seed round led by Veranium NextGen. Existing investors Aniket Capital and Gemba Capital also participated in the funding round. Overall, the rural fintech has now raised a cumulative funding of $16 million in equity and debt. The fintech plans to use the raised money to expand its ASEN tech platform. Lending platform Oxyzo's profit after tax, or PAT as they call it, jumped by 185% to 197 crore rupees in FY23. The increase in profit comes on the back of a rise in its total income. Speaking of which, the total income as per the company statements increased by 80% to 562 crore rupees in FY23. In FY22, the firm's total income was at 313 crore rupees and its PAT was at 69 crore rupees. Moving on, digital lending industry continues its upward trajectory with more and more loan disbursements. A report by IIFL Fintech said that digital lending increased at a CAGR of 39.5% over a period of 10 years. In terms of investments, more than $1 billion was invested in the digital lending space. By 2030, the digital lending market is expected to grow to $515 billion. PayPal will be selling a part of its BNPL loan business in Europe to KKR for $43.7 billion. A Reuters report said that the deal is expected to generate about $1.8 billion in gross proceeds. Once the deal closes, PayPal expects to allocate roughly $1 billion to incremental share repurchases in 2023. This is set to take the total share repurchases to about $5 billion this year for PayPal. And Tamil Nadu is looking to fulfill its fintech ambitions by setting up a fintech city and fintech tower project in Chennai. The fintech city is expected to create an investment of 12,000 crore rupees and create 80,000 jobs. It will also house international and national BFSI institutions, while the fintech tower can generate an investment of about 1,000 crore rupees and also provide jobs to 7,000 people. Now, getting the best smartphone at an affordable price is always difficult, especially if you're looking to buy a branded smartphone. But Chinese brands have broken this barrier by offering the best smartphones with the latest features at lower prices. However, one particular brand, RealMe, has fallen on the government's radar for allegedly stealing personal data of its users. Before we play the package, here is a question for you. Are you using a RealMe smartphone to watch this episode of Finomoney? If so, then somebody could be watching you.
Chinese smartphone company RealMe is facing allegations of data theft of users. The government has ordered an inquiry into it. If you're also using the smartphone of this company, then you should stay alert. RealMe smartphones give better features at a lower price, and this is the case with other Chinese brands as well. This is the reason why Chinese companies dominate the smartphone market in India. According to a report by research company Counterpoint Research, 4 Chinese brands, namely Vivo, Xiaomi, Oppo and RealMe, accounted for 54% of the total smartphones sold in the country in the first quarter of the calendar year 2023. Vivo, Oppo and RealMe have the same parent company, BBK Electronics, and all the phones of this company has the enhanced intelligence services feature. It is this particular feature which has put Realme on the radar by the government for data theft. Apart from Realme, Vivo, Oppo and another brand of BBK, OnePlus also has this feature. Realme, on its part, gave a clarification saying that the data of customers remain intact within the mobile and will not get leaked out by any chance. Now, this issue came to the fore recently. Apparently, a user on Twitter tweeted about the enhanced intelligent services feature present in Realme phones, collecting their personal data without their consent. In our phones, generally, there are so many features. As per smartphone companies, enhanced intelligent services is also one such feature. This feature makes the phone user-friendly, but now it looks like it also collects personal data of users. And this is something smartphone companies did not inform you. If these features are for the convenience of the users, then it should be made mandatory to take consent from them. But that's not the case. Now, this accusation does not stop with just Chinese companies. Even South Korean company Samsung is also included in this list. Samsung's Galaxy S20 FE also has such features. This phone also has a feature called Send Diagnostic Data. This is a default feature which is always on. Due to this, your information keeps getting collected in it. However, it has not been confirmed that why smartphone companies are collecting users' data. Since this relates to Chinese companies, it can also be an issue of national security. Adding to all of this, another concern is also related to turning on the location. There is an inbuilt feature in the smartphone which shares a very important information related to us with all the apps. We are talking about GPS here. Apps, by keeping the GPS active, get information about where you are going and send you promotions and target ads based on where you are at. Now, when it comes to smartphone companies stealing your data, they have information of your location all the time. Hope what we just said got your attention now. Because the next time you buy a smartphone, you will not blindly give permissions to apps and also not hit the I agree option without reading the terms and conditions. If you do so, then your phone will become an eye or an ear for some unknown stranger or entity.
We now move on to our next segment, which is our Q&A. Today we are going to discuss on mutual funds, and to speak on this we have Mr. Harsh Gehlot, CEO and founder Finnish. Welcome to the show, sir. How are you?
Very good, Ajay. Thank you so much for having me over.
All right. My first question to you is, how should first-time investors go about investing in an SIP, especially through a fintech as against an AMC?
It's a very good question to start off with. I think I'll just give a background. Most people I see today, when they approach investing, one of the biggest questions that they have is, which fund should I invest in and how should I invest? So primarily one from a financial planning or an investment plan perspective, that is not necessarily the right approach. If you already decided that you're going to invest somewhere and it's more of an ad hoc investment and you've selected a fund, then it's best to go through an AMC and make that investment, because there are multiple advantages. It's easier thereafter. It's just, since the fund is of that AMC, you go to that platform and you invest and you get the benefit of going direct. If you go through a fintech, they might add on a few services. For example, you'll have more open architecture. So within one fintech, which distributes or allows you to transact on mutual funds, will give you all the options. And thereafter, you can choose multiple AMC products under one platform and then invest with them. However, those platforms could be, or a fintech could be of different kinds. There are various business models. Some of them could charge you a fee. Some of them could have regular funds. That means they make commissions. And some of them might be free and direct, but will cross-sell you products which might not be best for you. In the end, all of these platforms will make money.
All right. My next question to you is, before investing in a mutual fund, how much percentage of the fund should be diversified into equity and debt? This is one question that comes to every first-time investor.
Yes, and traditionally there is a problem in the way the industry approaches. I think this has been oversimplified for generations. There are some weird philosophies involved in investing, which is a thumb rule. Your age minus 100 should be the allocation towards equity. But we truly believe these are incorrect. This is not the right way of approaching your asset allocation. That is very, very important. According to me, two things: asset allocation and risk profile cannot be associated to a person. They have to be associated to a goal. For example, I'll give a small example. Let's say I'm 60 and I'm retiring and I'm investing money for 2 or 3 years, or I'm investing money to get accrual monthly income from that. Then my risk profile will be very low. That means 100% of my allocation will have to be towards conservative funds where there is no risk on capital. But the same person, I'm 60 years old, and I'm, let's say, investing for my grandchildren's education 20 years down the line, then 100% of my allocation should be equity. So we at FinEdge, we strongly believe that asset allocation and risk profile is not to an individual, but to the goals. And coming back to your answer, if I was to simply answer that question, the longer duration the goal, the higher the allocation towards equity. Not just that, if your goal is 10, 12, 15 years away, that allows, and you're investing, let's say, in a disciplined manner every month, then that reduces your risk significantly by being in the market for such a long time. And typically, it allows you to take more risk. That means not only would you be 100% equity, let's say you're investing for 10 years, but you could also probably take higher risk and go and have a portfolio which is more skewed towards mid cap and small caps.
All right. Moving on now, how will the new regulation on execution-only platforms of mutual funds impact fintechs offering investment services?
So this is a small regulation which has come in. All of it is not yet out. It's only partially out the paper. I think SEBI is trying to fix an anomaly in the system. We've seen in the last 2, 3, 4 years, a lot of new business models have come into the industry. And a lot of them, if you see, I think there are 2 or 3 problems that SEBI is trying to address here. One is that many people were not showing interest in distributing mutual funds because there was no revenue doing that in direct plans. A lot of these new execution only platforms, you can call it DIY platforms, execution only platforms, etc., where there is no human intervention. Then people just go and select fund, which again, as a company, we have a very different thought process on, not necessarily in the best interest of an investor. But a lot of these platforms do exist. A lot of people do use them. And in that case, what was happening is they were cross-selling a lot of other products. So mutual fund was a hook for them to free mutual fund direct investments. And then a lot of them were thereafter cross-selling other products like insurance and loans, etc. In the end, everybody wants to make money. That case, they were losing interest on mutual funds because there was no revenue to be made. So the EOP regulation, which has come in now, allows a person, a company, to have an execution-only platform, be in direct, and charge money from 2 places. They have the availability. One, they could be agents of the asset management company. That means they could take some amount of money from the asset management company, even though they are giving direct plans. Or they could be agents of the client where they will give direct mutual funds, but charge the client. How much of this can they charge and what will be the limits to that? That paper has still not shed light on that. The regulation says that they will come up further with details on the technicalities involved in what can and cannot be charged to the AMC or to the client. How much of this would be really successful as a business model, or how will it stop or generate interest for these business models to exist? I think the question is not fully answered. It will take time, and we'll see how business models respond to this.
My next question to you is also more or less on the same thing. Do you think fintechs will now get a lot of traction for regular mutual fund plans after this new rule comes in place from September 1?
I think on that front, I don't think this regulation per se will make a significant difference because there's no added advantage to any of the business models really, or to the end user. So same thing still exists. You have regular plans and you have direct plans. over the last 3-4 years, if you ask for my personal opinion on this, there was a lot of hype around direct plans. A lot of people who especially first time investors, who jumped onto this bandwagon of saying investing is easy, I'll do it myself and I'll go direct. We've seen a significant shift as far as that thought process goes. People have tried that for 3-4 years and realized that while investing might be easy, creating wealth isn't. And there is a certain amount of help that you need. There is a certain amount of human intervention that you need. So from a point where there was a huge amount of hype on direct plans, we've seen a significant shift now where people have experienced that, maybe not made money, struggled with emotions, behavior, selection of funds, discipline, process. And at Finage, we've seen a lot of direct clients come to us and say that, listen, not happy with what they've done and they want to change that. So I think any change on regular or direct will be not on the basis of this regulation, but overall in terms of the value add that a person, which is in the end, the person wants to be a successful investor. I think if that is not achieved, everything else is lost.
All right. Just one last question before we let you go. How has 2023 been for your company and what's the future looking like?
Well, 2023 was a very, very interesting year for us, specifically because we feel we've come out of a huge 10-year period of incubation. So we've used that 10 years to get our go-to-market strategy right, identify exactly where we want to be in this industry. And then we spent the last 4-5 years developing the tools, the softwares, etc., that we need to add value to our clients. So we are not a DIY platform, and we do have investment managers dedicated as well as technology. Perhaps this year we've launched all our services together, and one of the biggest advantages that our business model provides is the fact that we are not DIY, but we have full technology deployment, and we have people who are experts at helping people invest. So it's our first year of attempting a scale up. So this is where we really feel we are about to cross about 1,000 crores of assets under management, which are all goal linked. But I truly do believe this is just the beginning. It's the first year of our real existence.
All right.
And the future for us is from here on, hopefully. 2023 will be a year that we'll remember when we started off.
Okay. That's all the time we have for this discussion. Mr. Gehlot, thank you so much for coming and sharing your insights. Take care.
Thank you, Ajay. Thank you very much.
And now it's time to look at some trivia. The RBI had banned the FLDG model last year, but recently it had once again revived the model with some new rules. So, what is this FLDG model and why fintechs want them back? Let's find out in Finogyan.
Just recently, RBI brought back the FLDG model, only this time with stringent rules and regulations. Regardless of the new rules, fintechs want the FLDG model back. So what is this FLDG model and why fintechs want them back? This video of Finogyan will tell you that. First, let's understand what FLDG is. FLDG, or First Loss Default Guarantee Scheme, is where a bank and a fintech enter a lending agreement where the fintech guarantees to compensate a certain percentage of default in the loan portfolio. This idea of risk sharing with the fintech partner encourages banks to extend loans to a large unserved pool of customers. So, if banks were happy with this sort of arrangement, why was it banned by RBI in the first place? You see, when FLDG was first launched, there were issues regarding the guarantee limits offered by fintechs to banks. For example, let's say a fintech facilitates a loan pool of rupees 10 crore. It offers FLDG to compensate up to 10% of the credit risk, which is 1 crore rupees. Now, sometimes this credit risk guarantee went up to 100% in the absence of RBI supervision. Now, were fintechs capable of taking such a big risk? According to RBI, the answer was a no. Following which, the RBI has imposed a ban on the FLDG model in August last year, calling them synthetic securitization. However, the RBI had revoked the ban on FLDG and has also capped the default guarantee at 5% of the portfolio amount for fintechs. And for fintechs, well, they are happy with the FLDG model, as anything above 0% is good because it allows the revival of their business. Not only that, according to news reports, a low FLDG is also good, as fintechs more often than not struggle with the capital that would get logged in. Apart from this, borrowers with lower credit scores and limited credit histories would benefit from this model, and the new guidelines also mandate stronger customer protection measures.
And it's time to draw the curtains on another episode of Finomoney, the FinTech Show. Download the Money9 app and stay tuned to Money9 English's YouTube channel for reality check and spendwise premiering Sunday. Also check out Money9's website www.money9.com. This is me, Ajay, signing off. See you again in July. Until then, take care, goodbye and adios.